So hello everyone and welcome to the day 14 of our miscellaneous insurance course. Today we are discussing a very specialized but incredibly powerful tool for business, that is credit insurance. This policy is all about protecting your company from the risk of not getting paid for the goods and services you sell on credit. We'll explore what it covers, the specific commercial risks it mitigates, and why it's strategically vital for any business that offers trade credits to its customer. So, what exactly is the credit insurance? It's a policy that acts as a safety net, protecting your business against the risk of not getting paid for the goods or services you sell to your customers on credit. This non payment must be due to specific reasons covered by the policy. The main goal is to ensure that your business receives its payment even if your customer becomes insolvent, meaning they go bankrupt or simply cannot pay their outstanding invoices. So, credit insurance can be tailored to cover different types of the trade. It can protect your sales within your country, or it can cover your sales to international customers, or even both. What are the common risks covered by the credit insurance? These are the typical reasons why a customer might not pay their bills. Insolvency or bankruptcy, this is a primary risk. It covers situations where your customer is legally declared bankrupt or enters into formal proceedings because they simply cannot pay their debts. Protected defaults, late payments. This covers the situation where the customer simply fails to pay undisputed debts within a specified extended period, for example 90 or the 120 days after the original due date, even if they are not formally bankrupt. It's for those long overdues, uncollectible debts. Political risk. This is particularly relevant for export credit insurance. It covers non-payment due to unforeseen political events in the buyer's country, such as wars, civil unrest, or revolutions. Restrictions on currency transfer that prevent your customers from sending money out of their country. If the buyer's business is expropriated or nationalized by the government, or if their import or export license are unexpectedly cancelled. It's crucial to understand the key exclusions and important considerations with credit insurance. This policy does not cover non-payment that arises from a commercial dispute between you and your customer. For instance, about the quality of the goods or the delivery terms. This needs to be resolved commercially. So it's typically exclude debts owned by companies or entities that are related to your business or part of the same group. The insurer expects you to have the sound practices for vetting your customers' credit worthiness and for collecting payments. If your own processes are weak, your claim might be impacted. Debts owned by the government entities are generally excluded unless specifically endorsed. This policy does not cover losses due to changes in exchanges rates, as that's a market risk. Any fraudulent acts committed by your own business are never covered. You'll typically have a deductible or excess, meaning you bear a first loss amount for any claim. And importantly, coverage is usually subject to credit limits that the insurer sets for each individual's customers. They will assess your customer's credit worthiness and set a maximum amount they will cover for that customer. So, what is the strategic importance of the credit insurance for the businesses? It's a powerful tool for fueling growth and mitigating trade risks. It opens up growth opportunities. It provides significant risk mitigation. It leads to improved cash flows. You might get better lending terms. It offers enhanced credit management. And finally, it facilitates market expansions. With the assurance of the payment, you can more safely enter new domestic or international markets, knowing your receivables are protected. So that concludes our session on the credit insurance. It's highly specialized but incredibly valuable policy for modern trade. Now I would love to hear from you. For a business looking to expand into a new, potentially risky international market, how would credit insurance be more beneficial than simply asking for upfront payment from all new customers? So what's the trade-off? So share your thoughts in the comments below. Thank you so much.